Hello and welcome to the screencast for the equation analysis sheet. This screencast is going to guide you through the steps of creating an equation analysis sheet, and in doing so, we're going to illustrate how business transactions affect the financial position of an organization. For the complete and detailed instructions, you can refer to section 3.2 of your Accounting 1 textbook. So we're going to start out with a blank equation analysis sheet. And at the top of the sheet, you need to write down the fundamental accounting equation, assets equals liabilities plus owner's equity, and then list the items in those assets, liabilities, and owner's equity sections. So in this case, the company that we're looking at is Metropolitan Movers. They have 5 different assets, 2 liabilities, and the owner's equity capital account. The equation analysis sheet is not a formal financial statement, like the balance sheet that we looked at back in Chapter 2. So we don't need to have the same heading that we looked at with the balance sheet. This is a more informal statement. Once we've listed the assets, liabilities, and owner's equity, we can start to record the initial balances from the balance sheet. To do this, we need to look at the balance sheet of Metropolitan Movers. So we have one here from September 29th that lists the values of the assets, liabilities, and owner's equity, and we can see that those values have been transferred into the equation analysis sheet. Once that's done, we can start to look at our transactions. Transaction 1, Metropolitan Movers pays $1,200 cash to reduce their bank loan. The first step is to record changes to the appropriate accounts. In this case, we're paying $1,200 cash, so our cash asset decreases by $1,200. And we're reducing our bank loan, the amount of liability that we owe to the bank, so our bank loan liability decreases by $1,200. Once we've done that, we need to record the new balances. Every time you record new balances on the equation analysis sheet, you should check to see that the equation still balances. In other words, do all of the assets equal the liabilities and the owner's equity? And if you did the math here, you would see that yes, they do equal. At any point in time, the fundamental accounting equation, which is assets equals liabilities and owner's equity, must balance. Now we can move on to transaction 2. K. Lincoln, who owes Metropolitan Movers $2,500, pays $1,100 in partial payment of his debt. So the same process applies. We record changes to the appropriate items. In this case, we're receiving $1,100 from K. Lincoln, so our cash asset increases by $1,100, and K. Lincoln is paying down his accounts receivable. So we decrease K. Lincoln's accounts receivable by $1,100. Once that's done, again, we will record the new balances and make sure that the equation still balances. Our third transaction, equipment costing $1,950 is purchased for cash. So again, we record changes to the appropriate items. We're using cash to purchase the equipment, so our cash goes down by $1,950, and we're receiving equipment, so our equipment asset increases by $1,950. Again, we record the new balances and make sure that the equation still balances. Assets equals liabilities plus owner's equity. The fourth transaction, a pickup truck is purchased at a cost of $18,000. Metropolitan Movers pays $10,000 cash and arranges a loan from its bank to cover the balance of the purchase price. So this is a more complicated transaction than the previous ones, but we'll see that the steps are always the same with the equation analysis sheet. No matter what's happening in the transaction, we always follow the same steps. So first off, we need to record any changes. We're paying $10,000 cash, so our cash asset decreases by $10,000. We're getting a pickup truck of $18,000, so our truck asset increases by $18,000. And we have arranged to increase our bank loan to cover the balance of the purchase price of the truck, and that balance is $8,000. You'll see here that any changes based on each transaction have a way of canceling themselves out on both sides of the fundamental accounting equation. So in this transaction, we're decreasing cash by $10,000 and increasing trucks by $18,000, and there is a difference there of $8,000. And we see on the liabilities and owner's equity side, we have the increase of $8,000 there. And if you go back and look at any of the previous transactions, you'll see that for transaction 3, we've decreased cash but increased equipment, so balanced out that side of the equation analysis sheet. The same thing has happened in transaction 2, and in transaction 1, we've decreased assets and decreased liabilities, so that's how our fundamental accounting equation remains in balance. So again, we've calculated the new balances, and we can move on to the next transaction once we check that everything is equal. Transaction 5, Metropolitan Movers completes a storage service for B Cava at a price of $1,500. A bill is sent to Cava to indicate the additional amount that is owed. In this case, no cash is changing hands, but B Cava owes Metropolitan Movers $1,500, so we increase B Cava's accounts receivable by that amount. Because Metropolitan Movers is getting money from this, we are able to increase owner's equity by $1,500. So they haven't received the cash yet, but they've added value to the company by providing this service. And again, we calculate the new balances and move on to the next transaction. Jay Hoffner, the owner of Metropolitan Movers, withdraws $500 for personal use. So Metropolitan Movers has $500 less cash available, so cash decreases by $500, and owner's equity is going to decrease here by $500 as well, because that $500 is no longer available in the business. So it reduces the value of the company. We calculate the new balances again and move on to the final transaction. One of the trucks requires an engine adjustment costing $375. The repair is paid for in cash when the truck is picked up. So we know that cash is going to decrease by $375. And this transaction's a little bit tricky because you need to ask yourself, is the truck asset going to change value? And it's not here. The value of the truck remains the same. This is just a repair that has happened to the truck. So in this case, this money is used up and no longer available for the company, so owner's equity is going to decrease. Finally, we calculate the new balances at the end of transaction 7. Once we have the final balances from the equation analysis sheet, we can create an updated balance sheet with those values. So here you see a new balance sheet for Metropolitan Movers, and we've taken the balances of the assets, liabilities, and owner's equity and entered them into the balance sheet. That's everything for the equation analysis screencast. Thanks for listening.